Hey YouTube, today's video is on building your credit. And I feel like there's this huge train of people for the past couple of years that have been really big on cash for everything and not having credit cards. And so I totally get that. If that's you, this video probably isn't for you. I'm not telling you to go and sign up for all these different credit cards, but I will say that credit is very important in today's world. I'm going to tell you exactly how to build your credit, what goes into that credit, and how to maintain it over the years. Like and subscribe, and let's go. First things first is that you need to know credit can move up and down really fast just in a matter of months. For those of you who are teetering on the brink of not knowing if you want to be fully cash or if you want to have some kind of credit, I'll tell you why I think credit is a good idea. Going full on cash is a great option to have, but the majority of people, the day-to-day average Joes, average Janes, are not going to have enough cash on hand to be able to do things fully cash. Building your credit means being able to get a home loan, an auto loan, a personal loan, some kind of line of credit, opening anything like a business line or a business credit card, and even renting a new apartment or home. Your credit establishes you as a person and your worthiness for someone to lend you money when needed. Obviously, if you've got a lot of money in the bank and you don't need someone to give you money, you can just pay everything in cash. Good for you, great for you. I don't know what you did. You should let the rest of us know, but most people are not going to be in that situation. And that's okay, that's normal. For those of you not in the situation, you really do need to focus on building that credit. So what goes into that credit score? Your credit score is made up of a few things. The biggest and heaviest category that goes into building your credit is your payment history. This means that anything that you have to make some kind of monthly, weekly, daily payment on, these sources, these companies are going to report whether or not you pay them on time. Whether you didn't pay them at all or you paid them a day or super late, these companies have every right to report your payment history to the credit bureau and ding your credit. The next biggest category is your credit usage. And this means of all the credit you have to your name, how much of it is available for use. Really what this is telling people is how good you are with your money. Of all that you have, how much are you using and how much do you have left over in case of whatever. And really all this means is, have you been using your money wisely so that you do have open lines of credit, you do have an open balance to use if needed, because the point isn't to use everything that is available to you. The point is to have a huge capability without really the need to use it. When this does happen, you appear as very efficient with your money and your credit. Next is the length of credit history, and this means how long have you had your accounts open? Has this person bounced around, opened 5 accounts in the last year? Have they had them open just recently? Have they had a credit line for 10 years? And for those 10 years, have they been paying those payments on time? If you were to look at someone's credit report and you saw that they had 4 open accounts in the last year, it would kind of look like they might be in some financial trouble. So when this appears on a credit report, creditors are able to see, hey, maybe this is not the best decision to be lending to this person. We are going to deny or maybe not give them as big of a credit limit if we do approve them. Because this is a category, it's very, very important to remember that just because you don't use a line of credit anymore doesn't mean you should close it. Because when you close it, you are deleting that account from your history. Let's say you had a Wells Fargo card for 7 years and you decided, I don't use it anymore. It's just sitting in my safe box. I'm just going to go ahead and close it. A couple of things will happen here, but in this category specifically, you are deleting 7 years worth of credit history. Do not do that. The only reason I could see that would make sense to do that is if you paid some kind of huge annual fee for that card, which in most cases, the annual fees are probably not going to outweigh the fact that that balance and closing that is going to have a huge impact on your score. The last and final category is the credit mix. And this means of all the lines of credit you have open, what are they? Are they loans? Are they lines of credit? Are they credit cards? What kind of credit mix do you have? And this is important because people are then able to see what kind of portfolio, what kind of financial portfolio you have to your name. And the more you have, not that you should go running trying to sign up for everything, but the more you have just makes you more reliable because you look like you know what you're doing with your money. Lastly, I'm just going to go over a couple of things you should know when you're starting to really dig into credit and building that credit. There are 3 main consumer reporting agencies, and these 3 are Experian, TransUnion, and Equifax. And these three are going to be the main companies that dig up all this info and keep all this info on you about your payments, about your credit history, all of that good stuff. And they're going to be the ones that report or send you this official report to say, hey, we ran the numbers and this is what you are valued at in the credit world. Let's say you did go and apply for a credit card. That credit card company is going to pull a report, a consumer credit report from one of these three agencies, and sometimes they pull them from more than one, and they average that score out. When your credit is officially pulled, this is called a hard pull. This hard pull is going to end up on your report. If you haven't had your credit pulled in a long time, it probably won't affect you that much. If you've had your credit pulled recently, having it pulled a couple of different times will not do great things to your score because it's going to look like you're desperate and asking a whole bunch of people for money. But in general, when you get it pulled, it will ding your score maybe a few points. Again, if you've been doing it a lot, maybe more than that. But this just shows that you are looking for money. You're trying to expand your portfolio for whatever reason, and it's going to be up to whatever company or person who's looking at your credit to determine whether or not you're a desperate person based on everything else that your credit history shows. Whenever your credit is officially pulled as a hard pull, you get a copy of this, whether it's electronically, whether it's mailed to you, you get a copy unless you opt out. I always keep these copies for my reference to know exactly where in time this happened, who pulled my credit, yada, yada, yada. If you're pulling your credit in order to borrow money, your rate that you get is going to be a direct reflection of your credit score. So basically, if you want a really good rate from month to month or annually, you want to make sure you have a high credit score that says, hey, this person's going to be a good borrower. They're going to pay on time. They've got enough money where they're not super desperate. And they have a lot of accounts, a lot of people saying that they've been a good person to borrow money to. If you do have a good credit score, good for you. You're probably going to have a lower interest rate than people who don't have a good credit score. The first step to building your credit is opening some kind of account. And that means some kind of credit line, some kind of loan, or some kind of credit card. And I know that's scary. Not everyone wants to borrow money, but no one's asking you to get a huge sum of money in that account. Simply opening a $500 line of credit will boost your credit in the long run. Building your credit really comes back down to just being a good steward with money, borrowing money, having the capability to borrow that money, paying it back in a timely manner, and eventually paying it off. In this day and age, you need a credit card just to rent a car. You need a credit card for, to hold money anywhere. And so building your credit is a big deal because you eventually do need it. I am definitely not against being debt-free or being all out for cash. But I do think that credit has a very important place in today's world, and knowing how to navigate that world is really going to set you up for financial success. Whether you have thousands of dollars in your credit limit or just a few hundred, it's very important how you utilize all of that so that you can have the best and the highest score possible to get you the best rates and financial resources out there for when you do need them. As a review, the first step is to open an account. Once you have that account open and you've borrowed a little bit of money, pay it back on time. Make sure you're not using all of the credit that you have available. And then eventually open up new cards so that you have a good credit mix. And keep those cards open in order to establish your credit history. It really is just that simple. Building your credit is a lot of work, it takes a lot of responsibility, and a lot of adulting. If you're not ready, that's totally fine. You've got a lot of time to build it, and you can build your credit score really fast, like I said in the beginning, or you could have it go downhill really fast. But either way, it's simpler than people make it seem, and anyone can do it. I'm thinking I'll be back to talk more about this topic, but if you have any questions, comments, or video ideas, leave them down below. Don't forget to like and subscribe for more everyday skills for everyday people. I'm Becca, and I'll see you guys next time.